Hello everyone and welcome to today's webinar on card payments for Treasury. In order to eliminate any background noise during the presentation, we ask that everyone please keep your microphones muted. This webinar will consist of a 55-minute presentation followed by a 5-minute question and answer session. Please feel free to post any questions you may have throughout the webinar. We will answer them when you ask or in the Q&A session. If we do not get to your question, someone from our team will follow up with you. Today's webinar is eligible for CTP and FP&A recertification credits. The credit forms a copy of the deck, and the recording will be sent via email in the next 7 business days. Our presenters today are Craig Jeffrey, founder and managing partner of Strategic Treasurer, and Stephanie Villatoro, senior consultant of Strategic Treasurer. Welcome, Craig and Stephanie. I will now turn the presentation over to you.
Welcome and good day. Thank you, Michelle. I'm glad that each of you could take some time out of your schedule to listen to our webinar. And Michelle, if you would advance the screen for me, that would be excellent. I'm having some technical problems. So how we can participate in today's webinar, there are several different ways of doing that. One is in the chat box where you can type in any questions as they come up. And the second is by joining one of the LinkedIn groups that we have listed at the top. We have a Treasury group, and we also put in a security group since we will be talking about some of those topics. So those are 2 good ways to join and expand the conversation. So we look forward to seeing you in those forums. And then finally, we have polling questions, and your participation in the polling questions are most appreciated. As you answer, we can see who's responding to different perspectives or taking different actions in different areas. So that will be excellent. I'm going to give you a quick overview of our agenda, and we'll start with what's on the screen. So we'll talk about Treasury and payments in context. This is the view of what Treasury is doing, how payments are changing. Then we'll give an introduction to cards and some of the elements about how these are different options, what Treasury needs to do and consider with card payments. And when you think about segmenting payments you make or receive, cards can oftentimes play a useful role in them depending on your type of business and where it fits in. Then we're going to look at cards for Treasury, the different types of programs that exist. And then when we look at a growing influence, there's a couple factors that differ, or that seem to be moving in different directions. Treasury is investing more in card programs, and you'll see information from that perspective. And finally, we'll see how some of the newer demographics that are arising are muting how much cards are available on the consumer side. So it's just interesting to see some of these changes taking place in those factors, in regard to those different areas. Then we'll look at considerations for Treasury and wrap up with a summary. What are some takeaways for that? And look at some growth as well. So we'll just advance to the next slide. And when we look at the Treasury situations, the challenges and considerations, I guess I'll start off on the left side where we say, what are the common responsibilities in Treasury? You know, cash positioning seems like it should be 100%, but Treasury, when you look at all company sizes, fits in 86% of organizations. Sometimes that activity sits in another area. They're not doing any of those functions. As you look at cash forecasting, 80% of firms do that. And as you move down, managing liquidity, handling the cash conversion cycle, working capital, all play roles in most Treasury groups of an organization. So that's the context of their responsibilities. Very similar from organization to organization, yet there are distinct differences from one place to another. Now, as you look at the challenges and considerations, you have that diagram with the arrows moving in and out. This is what are some of the top concerns, or where are we concerned? You look at rising fraud in payments, collections, concern about data. This is a significant issue that impacts almost everyone. A second key area has to do with efficiency. When we've taken some surveys, efficiency is either top or second on most Treasury groups' perspectives in terms of where they want to see improvement, addressing fraud and being more efficient. And as you continue around that pie, you can think of the issues of we don't have a lot of staff yet, so we need to be efficient. We have more expectations about risk, more expectations to meet our needs as our organization goes global or expands the percentage of our business that are in other countries other than our home country, and the ongoing complexity that happens as we deal with more product lines, we acquire organizations, we're dealing with more countries, we have an increased number of payments and options. Those all create the context of more challenges, more complexity, and so that those rising expectations are real. So how does Treasury handle those and address those? But let's look at, as we do that, we'll move to the next slide where we talk about analyzing Treasury's payment mix. Treasury has a number of different payments that they have to deal with and support. You go to the grocery store, they say paper or plastic for your bag or bring your own. How do you pay for it? With a debit card, a credit card, cash, even if you get stuck behind someone with a check, you might experience that that joy where someone pulls out a check and they write it, and then your kids say, "What is that?" So there's a mix of payment options that Treasury has to manage and support as part of a business approach to activity. So just a couple things on this slide. So we looked at what are the approximate payment volumes generated globally per month for your business. And if you look at that red highlighted area on the right-hand side, you look at the high payments complexity, you look at ACH, check and wire, you can see the numbers there. About 29% are doing ACH, check and wire. That's high, very large volumes, 100,000 plus. These might be non-bank financial institutions or very, very large retail-oriented companies. You look at card, obviously the numbers tend to be a lot lower because you're not using cards to make hundreds of thousands or millions of payments typically. So there's definitely a challenge. I think it's interesting too that when you look at ACH, wire, and check, how many, almost half, 45% of companies make more than 10,000 payments a month. And just so you see why we've created that scale that way, where each set of bars as you move over jumps up, one logarithm, so tenfold. So 100, 1,000, 10,000, 100,000, a million, 10 million, and then the last one is we just did more than 10 million. So you can see a large number of companies have very small number of payments, and yet there are numerous organizations that have a tremendous amount of companies, a tremendous amount of payments. So, but when we think about cards, 9% make more than 1 million payments a month or handle 9 million transactions for card, and 47% make more than 1,000. So pretty big difference. 47% of card transactions are 1,000 or more, and 45% are ACH, check, or wire of 10,000, so tenfold. So you can see some differences there. So I think most people in Treasury are pretty familiar with the standard Treasury payment types, check, ACH, wires, but card payments are not as well known or not as well used for everybody in Treasury. But I think when you look at how you make payments, there are particular areas where cards can be very, very useful on the disbursement side. And as you look and manage and see payments, it can help you manage and steward your resources. Even on the collection side, there are times when you say we want to collect these payments from their consumers. They might help increase their sales, or we're getting paid in 60 days. That interchange fee we pay eliminates the risk or carrying cost of open accounts. We can collect the money sooner, and we don't have a receivable process. So there are different elements, whether you're collecting or paying, where you want to look at your business payment mix, business collection mix, and segment your types of customers, your types of suppliers, and figure out what makes the most sense. Now, we'll jump to the next slide, and I'll introduce Stephanie, who will begin covering this. Stephanie.
Thanks, Craig, and welcome everyone to the webinar today. On this slide, I know Craig's talked about more overreaching, just different payment types for Treasury, but there's a few areas I want to point out here regarding Treasury's role in relation to just card management programs that we're showing on this slide, with corporate Treasury in the middle and just different areas there. The first one being is bank relationship management. Card services are part of a more overreaching scope of payments, but there are several key areas of the overall card process that Treasury must handle. The first is the relationship management we talked about. Treasury often is the lead as the relationship manager for their banks, and they play a very key role in negotiating the term of card services and deciding upon the scope of the services used. And we see this typically in an organization where they, for awarding business to one of its primary banking partners. And this is why we see card program management commonly fall under the role of Treasury. Another is Treasury is also able to negotiate the fees for services, and it adds additional negotiating power for reducing fees possibly in other areas in their cash management mix of services. So they do need to be aware also of the total cost, the fees associated with the cards, in order to effectively negotiate these across the gamut of services. Also, just knowing the fees by counterparty, so if you're utilizing a bank for your card services, this provides a comprehensive view of fees to ensure it's meeting your counterparty risk guidelines. The second item I want to chat about or second component of cards, is that it impacts Treasury, the actual payments themselves and being an authority on payments. Even though Treasury may not use cards directly, so they're not transacting the cards, they are the service center to those areas that do use them. So they're a service center to accounts payable, to payroll, or even to procurement. And being the overseer of cash, which includes these payments, they need visibility to all payment activity conducted by the organization in order to forecast cash flows and effectively manage liquidity for working capital. So we see even though the relationship between Treasury and card payments is not direct from an operational view, we can see the importance of understanding the benefits and opportunities for Treasury, as well as any challenges or costs. So that shouldn't be overlooked. And the final thing is working capital. And an example of this for a card program is earning cash back. Since most card programs provide some type of rebate or a cash back for purchases made on the card, this can also become a source of liquidity, and it's an effective tool for working capital or for managing working capital. Typically what you see is on a card program for cash back or for a rebate, it's based on a threshold. So the card services, the provider is going to offer rebates to the company as a reward for their use. For example, it's going to give you 2% or 3% cash back on all the transactions that's past this threshold. They could also have tiers amongst that for the savings. We'll move on to the next slide. So Craig talked a little bit earlier about the different types of payments and the usage amongst Treasury. So we're going to talk about them a little bit more here. Checks are the oldest. They're on the bottom in the gray, and the longest payment type Treasury's dealt with or managed. And while they tend to be regarded as less efficient or more costly than other methods, they're still very common here, especially in the U.S. I know you mentioned behind someone in the grocery store. It still happens, but I see it less and less. The ACH network up on the top can process batches and low-value, high-volume transactions, and it's the most commonly used in the U.S. Wires, the blue there on the left, are used for cross-border or international transactions or even domestic transactions dealing with those high-value dollar payments. While their cost is probably higher than the others, it's sometimes a necessary payment type that has to be done, and this tends to be for immediate needs that are non-revocable forms of payment for like an acquisition, a legal settlement, those types of transactions that require a wire transaction. And card payments, talk about those a little bit, they are used less frequently by Treasury among the other areas in the organization. So the Treasury must be familiar with them, but they don't typically use them. Cards may also be used by Treasury personnel in some circumstances, and it's typically for T&E, so travel and entertainment. When they're traveling, they use a corporate card. Card here ranks second among companies for making payments, but they're less attractive for receipts. And the reasons behind this vary between organizations, but it's typically about it. The reasoning behind that and why it's less attractive is issues with the automation of the back office for application of the payments being received. It could be reconciliation, maybe very manual, and also like transparency between the credit card receipts, then checks and EFTs, and also there's PCI compliance challenges. So that brings us to our first polling question that Craig, I know you mentioned that earlier. If you could pull that in, Michelle. So this question, I know you can't see it yet. Okay, there you are. So if everyone can take a moment to answer, for receiving payments, what is your most preferred payment type? We know from our past survey questions for receipts, it's typically not cards, it's more electronic type of payments. Can you make that a little larger there, Michelle? And that's what we're seeing here. We're seeing that ACH payment leads the pack at around 70%, followed by wires at 20%. Card checks and other are trailing for the remaining 6% or so. So I don't think we're going to see anything much different than that. So you may end the poll. And I'm going to hand this back off to Craig once the poll is ended to see, he's going to be talking about the market for plans for card payment programs.
Yeah, that's great. Thanks everyone for answering those questions. It's good to see the numbers pull in, and not surprising that ACH is more preferable, and especially when you say it's the most preferred. Now, when you think about stratifying different types of payments, ACH may hit the most groups of customers as your most preferred. It fits and feeds into your back office system. It's very affordable, but we didn't ask the question how. Is there a single method that you use and you shut down all others? So it fits into the whole play. So we'll move that poll question off to the side. Thank you for taking that. And then Stephanie had asked what are some of the plans, and we're sharing some information here in terms of plans to spend on card programs. So about the same as the middle. It's the blue bar, about 38% plan to spend the same. And then if you look at the orange and red on the right side, 5% plan to spend less or significantly less through their card programs. And then if you look at the two green, it's about 40% plan to spend more or significantly more. Clearly, those that want to spend more or significantly more vastly surpass those that want to spend less to the tune of 8-fold. It's 8x on the left, 1x on the right, and then we are about 8x plan to stay the same. So it's a pretty significant group of companies that plan to route and have more card activity in their organization. So that is substantial. So I think that's good news if you're a banker who's compensated on traffic going through your card program, and it's obviously it's good for a lot of companies to continue to expand the use of card sales and their card programs this year to drive that type of activity. So that's a quick aside on the sideline on the spending programs. So Stephanie, I know there's a lot of different card types. You know these off the top of your head. Not everybody thinks of every card type. Maybe you could go through some of the more popular card type programs.
Yeah, we'll go through each of these on the boxes here, but just to preface this, just depending on your organization, cards can be used by multiple areas internally that we talked about, including your AP department to pay vendors, procurement for purchasing supplies. Payroll will also use them for employee disbursements, using them as payroll cards. You have employees using cards for travel expenses, or what we call a corporate card or a T&E card. And you also might see organizations with fleets of vehicles where cards are used for routine upkeep and management, or sometimes they're even used for machinery. So in these different card programs, Treasury might be able to, they're able to manage the activity and understand how to track it, and also optimize the payments that are made. So let's look at each one in a little more detail and talk about some benefits of the programs as well. So as I mentioned, the T&E, the blue box in the top here, is a travel and entertainment card, typically just used for travel and expenses. And a strong benefit of these is it can accumulate rebates and or travel points at the corporate level. It also gives visibility to your Treasury group or to those managing expenses in a consolidated area. And from an employee perspective, you don't have to do those manual paper expense reports that we all love. So then moving on over to the P card. P cards are, as I mentioned, used for typically procurement or accounts payable for supplies, inventory, equipment, even service contracts. When you're evaluating the potential benefits of the P card program, one of the main advantages of it is to offer rebates. And when it does this, which are included at the merchant level, the rebates can be very valuable as a cash back and can contribute a department that's typically an expense center to a revenue building center. They can also delay the actual payment, which increases your operating cash on a short-term basis. So you're delaying those payments a little bit longer. And it's an effective tool in managing working capital because of this. And the one other thing about P cards is they, unlike T&E cards, they don't have to be a physical card. It can be a ghost card or a what we call a virtual card. Now the all-in-one is just a combination of the two programs I just talked about, T&E and P card. The advantage here is just simplifying your programs into one for company expenses, where you're using one merchant for both T&E disbursements as well as your AP. And then we'll talk a little bit about fleet. As I said, this is for maintaining large fleets of vehicles, like repair trucks. It is used for, gas, vehicle maintenance, repairs, and it provides a benefit here is it provides greater oversight to the cash flows associated with that fleet maintenance. These are typically physical cards held by employees that are used for operations of that fleet. The one you don't see as much, or I should say the two, but one is more than others. One is the declining balance. This is just like a gift card. It has a balance on it, and it deducts as you make purchases on it. These are typically used for specific projects or purchases, and there can also be time limits set on the card between a specific date period to be used. So if it's a project that's a 3-month project, after that 3 months are over, no more charges can be made, whether there's a balance or not. And this allows those exact limits to be made for employees. It could also be for a trip if there's not a T&E card program. And they can be reissued on the same card with a new balance on an as-needed basis. So they're reusable as well. And then the payroll card is just what it says. It's a card that is issued to an employee where instead of making a deposit into a bank account, you're putting an amount onto the card. These are mainly used where you have a lot of unbanked employees. They work similar to a debit card, but you don't have to have a bank account behind it backing it up. The limitations to them is there's no credit available on these. You cannot overdraft them. Some of them do offer cash back and rebate programs for certain purchases. And the one thing you have to consider here is fees may be assessed to the employee for using it. You have to look at the details behind the cards, and that could be account maintenance, card replacement, or ATM transactions. So Craig, I'm going to pass it over to you to talk a little more about statistics from these surveys we're seeing.
Sure, thanks. So what is the card use by type of program? I think one element that was interesting is it's very clear that Europe, Middle East, and Africa, the region, dominates the use of one cards. In North America and some other regions, there's more use of P card, AP card, and a T&E card, or keeping the T&E and P card separate. So the two green are the two cards that are used by over half of the respondents to our survey. There's a question in the box, where's the polling information from? We put it in very small letters below at the bottom of the screen. So this one was our annual survey with Bottom Line Technology and Bank of America Merrill Lynch, called B2B Payments and Working Capital Management Strategy Survey. You can get more information on our website if you want to download information or look at a recording on that, just so you have access to more data. But you can see those two dominate. Virtual card is about a quarter. You get to one card, fleet card. It's about 1 in 7 organizations are using those. Payroll cards only used by about 9%, certainly some room to grow. And then ghost cards, the difference between a ghost card and a virtual card is a useful discussion, but that's about 1 in 11. Have some sort of ghost card for those types of transactions. Now, we have another poll for you to participate in and see what others are doing. So I'll bring our second poll to the screen, and we'll widen it up. And this is a multiple choice. So actually, I think it's a single. Yeah, you just pick one. All you do is click in the circle. And when you click in the circle, you're good to go, that your vote will be recorded. And if you click somewhere else again, it will be changed. So as everybody's taking that poll, for those that have already finished, we invite you to join our Treasury group. You can see that in the chat box. If you click on that link and you just ask to join, we'll give that approval today, and that's another way to follow up. If you look up higher, you can also join the LinkedIn security group. If you're an overachiever, you can be in both of those. So yeah, we got about 150, 170, closing in on 200. So we've got a lot more people who can vote, quite a few more people who can vote. But let's go ahead and broadcast the results. So does your organization have a corporate card program in place? Numerous types. AP, T&E, 55%. Yes. A third have just one. And then there's a couple of no's, but they're looking to implement a program. And then 4% or so answer other. So maybe that's a maybe, or they're not sure what the status is. So this is excellent. We're going to move that poll question back off to the side. So thanks for answering. Really appreciate that. And we'll continue to move through with some more information from some of our surveys. So we ask about cards, and do you handle? Are you more interested? Do you prefer a discount for your payables, or do you prefer a rebate? And so when we think about that in the context of cards, there's rebates on certain cards. There's other programs where people offer a discount off the terms of their trade receivables, and people take advantage of them. Interesting shift. We take a lot of surveys each year with a lot of questions. And what's great is not just to see what the measurement is at a point in time, but to see how that changes and fluctuates from year to year, from size of company to geography. And it was interesting to see from the 2017 B2B payments and working capital management strategy to this year's working capital management, the preference for rebates jumped quite a bit from 22% of people preferred that to 30%. So it's 8% of the total population, but 8 over 22 is more than 33% jump in that proportion. So that was quite interesting to see that rebates are becoming more preferable. We didn't ask questions as to why they're more preferable. Is it because you want to become a money center or, a profit center and get funds back that you can divvy up as necessary if you're running the card program, or it's just easier to manage, or if there's some other aspect of it. But this is what people have responded to. So I think we need to, we've gone through some surveys, information, we've given the background. I think it's helpful to understand card charges and what those pieces are. So Stephanie, why don't you do the hard work of explaining that?
Yes, it is hard work. It's not just hard, it's typically very confusing. So we're trying to bucket it so it makes more sense, but managing card programs, it's important to understand how these fees work in order to manage it properly, and also to be able to negotiate the fees. So while the fees associated with any program vary based on the provider and the negotiation on you or the client, there's typically three main buckets, as I said, or types that we want to remember. The first being there is interchange fees. These are fees charged on the individual card transaction that are typically a percentage plus flat fee. That flat fee is approximately less than 25 cents per transaction, and that can vary. These fees are established by each card association, and when I say card association, I'm talking about the brands, the Visa, the MasterCard, the Amex, and the Discover. Both you can find both MasterCard and Visa interchange rates on their websites. They're public. Discover and Amex are a little bit harder to grab, but those two you can find. And they're collected by the issuing bank. So these aren't collected by Visa and MasterCard. They're controlled by the card brands, the Visa, the MasterCards and stuff, but they're rewarded to the issuing bank, which is the bank that's on the card itself. So when you see a Visa card by Bank of America or Wells Fargo, it's going to that specific bank for issuing the card, because they're the ones holding the risk there. So these do vary. The fees vary by transaction type, and there's two things that drive the interchange fee, and it's the type of the card that's used and how it's processed. So when I talk about how the card is used, is it at a point of sale? So are you swiping or dipping a card into a point of sale transaction where the physical card is present, or are you actually doing an online transaction? The more points of authorization or validation, I should say, that occur, the less the interchange fee is going to be. And then from the card type, I'll just give you two examples. If it is a reward card where you're getting 2% cash back on all purchases made versus just a standard debit card or credit card with no rewards on it, there's a difference in the transaction cost as well on that for interchange fees. Then we'll move over to assessment fees. Assessments are typically a percentage of the transaction amount that are assessed by the card associations back to Visa and MasterCard. They get their funds, Visa, MasterCard, Discover, and Amex. Unlike interchange fees, these assessment fees don't vary by transaction type. And another term you're going to hear when you're looking at credit card fees is the discount rate. All that is interchange plus assessment fees equals the discount rate. You may hear discounts in another term, you just not to be confused with other types of discounts. Then you have processor fees, and I call these merchant service provider markups. These are fees that are marked up by the individual card processor or merchant acquirer. These are fees to process the transaction on the merchant's behalf. So if you're a grocery store and you utilize Elevon or I'm trying to think of all the different ones, Payment Tech or a different provider to actually process your cards, they charge another fee. So every touch point has a fee. These are usually based on their expected transaction volume with you or with a client. And it's the only part of this process that is negotiable. The fee can either be fixed or a percentage of that transaction value, and they vary significantly from processor to processor and based on your volumes. And if you're using the same bank as the issuer, so if it's stacked, like you're using a Bank of America processor but also a Bank of America corporate card, they're still stacked. So you have the processor plus the issuer. And another thing to think about here is how they deliver the fees. So whether they are bundled together or what we call Interchange Plus. If the fees are bundled, the merchant processor is going to charge one fee no matter how the transaction occurs. An example of this would be Square. They charge a flat fee or a flat rate, which is typically going to be higher than what they're paying. And then the other type is the Interchange Plus, is really just interchange and assessment fees are it's a pass-through cost, and then they also charge you, their fee for the processor fee. So if you're looking at those, make sure when you're looking at fees, those are the things that you're going to be looking at and know what is negotiable. You have other fees that are going to happen, chargebacks. They might charge you for PCI compliance. There's just miscellaneous fees that'll occur as well. So now you understand fees. We're going to talk about the process of a card transaction. So it's important for Treasury to understand the process flow of a card payment. And the reason for this being is if you have a breakdown in the process from your terminals and the authorizations, these authorizations can be duplicated. So I've seen that before where they're getting double charged for authorizations, and that results in additional fees. So if you have a breakdown in your system, it can create additional fees as well. So I'm going to give a real-life example, to better understand this. So the card workflow is someone's making a purchase, and we'll just use an employee traveling using their corporate card at an airport kiosk. So in step one, they're inserting, which means dipping with the EMV card or swiping at a POS terminal. From that point, once they swipe, the payment message request is sent to the card issuing bank. Then it is authorized or declined. The issuing bank sends a message back to the merchant's terminal to let them know if it's approved or declined. And some of you may notice, since we have EMV chip cards, this takes a few seconds longer than when we swiped. And that's the validation process that reduces your fraud through the EMV chip card. So that takes a little bit longer, but it's worth the wait. So once that payment is authorized, then the transaction detail is submitted back to the issuing bank. And you might see on your smartphone that charge pop up if you have automatic notifications. The authorization hold is posted onto the cardholder's account, and then you have settlement. Settlement occurs from either in gross or net to the merchant from the card associations, your Visa, your MasterCards, and such. So Craig, that's the life cycle of a card, and I'll hand it off to you to talk about, or at least start our discussion on card considerations for Treasury.
Sure. So, as you look at this chart, there's 6 key considerations we'd look at. So when Treasury is evaluating how they can use cards in their organization, there's a number of factors that we really need to look at and consider. Stephanie described the standard workflow, the fee structures, and I see a lot of questions popping up in the box about fees, and so that I think we can probably answer some of those, but we might have to come back with some more details there. But all of these things have an impact on the value of a card program and on Treasury's decision to implement said program. So the range of these items include everything from the transparency, efficiency, compliance, security of the card program, the uptake or adoption of the vendor and the bank, as you use the card or offer the card to make that work. So each of these programs, each of these areas can vary depending on the card provider you selected as well as the type of program. And so these descriptions around the outside provide a standard overview of what makes sense. And I'll just keep moving through that for purposes of time. So with security is probably the top or one of the 2 top items on Treasury's mind the last couple of years. Depending on how you ask it, it's either that or efficiency. So with security, given the concern, the level, heightened concern about fraud and the increased level of fraud, this is a top consideration. And when we look at it, we know that corporations are being targeted. In one of our recent surveys, 46% of organizations had higher payment security concerns compared to prior years. And when you look at that, this is in the context of multiple years of people trying to strengthen their defenses, doing more and spending more. And you combine that obviously had an influence on 61% of organizations that said they had their security concerns had a strong or very strong influence on what they plan to spend on payment technology. So these security concerns and efficiency concerns are driving spend on payments. So with card, there's concerns from internal to the organization as well as external to it. So employees with access to cards may use them for personal gain or spending, or people may steal cards or the information and use them. So setting transaction limits, overall limits, monitoring activity systematically, your provider may be able to track that so it can detect anomalous behavior, put in either a concern or a pause on it. Those can be very helpful. So with external card, the EMV chips seem to provide a higher level of security over mag strips for physical purchases, as it continues to add a digit and calculate those things as you go from a terminal to you go from store to store. So there's some opportunities. Single-use cards have helped drive down the risk of stolen numbers, particularly for online or e-purchases. So there's a number of things that take place. And the other industry standard for that, or the card industry standard, is the PCI DSS. So this requires how you care and protect for cards, the security that's done on it, whether you store cards, they're encrypted, or whether you store tokens. But it also includes a level of security training for those who are users, whether they're accepting cards or they're the IT group. Each of those areas has to be trained. Now we look at transparency and control. Using cards, can allow you to regularly check on activity. I don't know if you do that on your own cards or your own bank account. You can see stuff, multiple times a day, very easily. You don't have to wait for a statement at the end of the month. So sometimes companies use specific cards for specific activity, such as fleet, travel, or share them with particular groups or individuals. And so some way of categorizing these either by cards or by reporting allows visibility and management at a very specific level. And fleet cards were explained by Stephanie, and you can see the value in having a very focused purpose card like that. So with all of that, as you look through, adopting these different types of cards or putting in place, this can allow Treasury to very effectively compare cost of maintaining different vehicles throughout the year if you're talking about a fleet program. It can also help with cash flow forecasts or other liquidity planning duties as you can gain better visibility into the very specific cash flows for the business. Now, I had mentioned security is one of the top items, or the top. The other top-level concern has to do with efficiency. So, Stephanie, if you would cover some of those.
Certainly, Craig. Thank you for that. So efficiency, you're right. It's a concern for Treasury in regards to the speed and accuracy in which they can settle a transaction internally, not the card transaction, but just internally in their systems. And we can use T&E for an example. So that manual submission of expenses and reimbursing employees can be a very large pain point for many organizations, especially as you grow and you have more and more expense reports occurring. With regards to managing card programs like T&E or corporate card, the organization should have an efficient and controlled process for the use of tracking and the downstream payment process back to the card, the issuer. For example, depending on the card provider, you could get card statements that are automatically delivered to a client's back office system, and while in other cases, statements might have to be manually downloaded or retrieved. So there's some differences on different card programs. They also might have an online portal that offers very robust reporting and views of card activity, expense reporting, or even being able to issue new cards or issue management for cards. That could also be if someone lost a card, making sure you close that down. So making sure the process is efficient. And then cost effectiveness is another one. We talked a lot about the P card and proper utilization of a program. This is a good example about changing the focus of a whole department from a cost center to a profit center, utilizing those rebates. If it happens to be an effective program and Treasury assists the other areas, the AP and the procurement, on developing the optimal strategy for the different uses of different payment methods, whether it's check, wire, ACH, and card, or the combination of several of these. We all know that not all vendors are going to accept credit cards, and you don't want to pay everyone with a credit card as well. But the key for a P card program is to maximize the rebate and also maximize any kind of discounts you can get for paying early. So some things you need to look at for cost effectiveness here is what vendors accept, what are your rebate thresholds you have to meet for really making it a viable solution to even use the program. And then, you know, the rebate versus the vendor discount, how do you optimize both? So these are some considerations where you need to take into account when determining if a specific vendor should be used as a card payment or an ACH. So it's a balance. And then, oh, go to the next one, sorry. We also can talk about a couple more here from our original thing, which was compliance and adoption of the program or promoting it. So compliance is one of the more confusing elements here, and we're not going to spend a whole lot of time on this, but this is the PCI DSS, which is the Payment Card Industry Data Security Standard. It was introduced back in 2004 by the major card associations. At that time, it was Visa, MasterCard, Discover, and Amex. And there are 6 primary objectives, which are listed there, from build and maintain, a secure network, you know, protecting cardholder data, and also having all the way down to a security policy. The main thing to remember here, or to keep in mind, is that all of these aim to ensure the security, privacy, and safety of cardholder data, which we're all very aware of in the world today, where we get notifications all the time that we have a company that's been compromised that includes our personal identifiable information, which could include credit card information. The adoption and promotion, once you begin a new program, the first step is determining which vendors will accept a card form of payment, which we talked about a little bit earlier. Some programs will identify vendors for you, so they'll look at your entire vendor list and actually say, this 80% of your vendors accept cards, and they'll help you manage the onboarding process of getting them into card payments. Keep in mind when this happens, it's important to understand that the vendors are contacting typically about the top 20 to 25% of your card spend and not the whole list. And you should be aware that there's an internal cost as well of contacting your vendors and this ongoing management. So that comes back to that balance. Historically, we did see that, you know, it was typically check and history, and other methods like ACH and cards have seen rising adoption. And this is in this little chart here. That being said, these surveys show that the majority of organizations with card programs in place have been satisfied with the level of vendor adoption, and they all say about 60% of satisfaction across all different program types. So we do see, you know, a good satisfied with the P card programs, the TNE, and the virtual cards here, that companies are satisfied with the program. But just keep in mind, if you're implementing a new one or you're re-engineering a current one, making sure you're balancing your different payment types and making sure it's optimized for your organization. Sorry, my slide didn't want to go forward. So we're going to look at now at just a look at the recent card innovations of what's been going on. So we have contactless payments as the first one here. This is your smartphone, bracelets, and other devices that are used that aren't a physical card being used to make payments. They use either radio frequency identification or near field communication. And as we have seen this growth in the e-commerce market, we've seen companies evolve along with it. That's resulted in different things, and I think one of the biggest ones we probably see on the business world is the use of apps such as Lyft, Uber, and those things that have responded to the demand in this e-commerce world. How does that affect business-to-business payments or B2B? It's mainly through the use of ghost cards or virtual cards. These are intended solely for the e-commerce world or business-to-business world that don't require an actual physical card. The ghost card, by using these ghost and virtual cards, corporates receive card numbers without the physical card, and they can be single-use cards or recurring card use. The ghost is typically one card number. Virtual can be many card numbers. They can be disposable, like I said, for a single transaction, and they can also have time limits on them as well. And this makes it more challenging for criminals to steal card information, which is nice. The second one there is tokenization. This came along, and there was a lot of questions about tokenization. This came into play with EMV chips on physical cards that replaced the magnetic strips. It's widely recognized as an improvement on card security, especially at the POS purchase. There's other innovations as well taking place, such as the layers of security through tokenization on sensitive card data. And Square Up explained it as, and I'm going to rephrase this here, or not rephrase it, but paraphrase this, in credit card tokenization, the customer's primary account number, they call it PAN, P-A-N, is replaced with a series of randomly generated numbers, which is called a token. So these tokens can be used through various methods of the payment process without the actual bank details, the card or the bank account. And it eliminates, fraud in the sense that your data is not being passed around, the actual card data. And then one that we're seeing a little less frequently, but it's on the cusp, is biometrics using fingerprint, a retinal scan, or even a selfie to process a payment. These add, additional layers to protection of your information or payments being transacted without your authorization. But as we see identity theft and fraud take on new forms, this should be very interesting to see how they would steal this information. So, Craig, I'm going to hand it off to you to look at that future outlook on cards.
Sure, thanks. So as we look at where people are going, you see the expectations for spending on the left side, which we talked about before, about an 8 times number versus those that are planning on spending less. So there's definitely positive traction, and the immediate road ahead is good for the use of cards. On the long-term outlook, I'm going to be brief, as we're going to do one more poll question, and we're right near the end of our time. There's a number of changes that are coming in place. Nothing stays exactly as it is. There's different methods of making payments and changes that are coming along and changing demographics. That's the area that I want to focus on for just a moment. When we look at the transitions and changes that have gone on or that are going on, if you look at a survey by Bankrate in 2016, 63% of millennials do not have a card. That seemed to be a massive, massive number. But a fairly recent survey by creditcards.com found that over a third, 36% of Americans aged 18 to 29 have never had a credit card. So this may seem strange or interesting to see lower adoption levels of card in the younger crowd. Maybe they're picking it up later, just like we see kids don't always want to drive as quickly as maybe we did when we were growing up. So there's definitely some demographic changes which have an impact and can have an impact on card use in the future on the consumer side, which may roll over into what's being done on the corporate side. But just some things to watch out for there and to pay attention. So if we look at our final poll question, this would be most interesting. We'll slide that into the screen. And so over the next 3 to 5 years, what direction do you anticipate your organization will take regarding use of cards? Expand, reduce, maintain? I don't know. So go ahead and answer those. We'll move that off to the side. I'm going to invite anyone who has completed to go ahead and click on the link for, if you'd like to follow Strategic Treasury on LinkedIn as a company, click on that link, and then you select follow, and then information from our company page on LinkedIn is there. We just love to have different ways we can connect with you. So these poll questions come in, the answers come in, we say, what direction do you want to take? So think about what you will see. I can have a preview here, and it is positive indeed. So I'll broadcast some of the results. You can see almost 60% plan to expand, only 5%, less than 1/10 as many, were planning on reducing their use of card services. Maintain is at 20%. This is a pretty positive group for using cards. I guess that's selecting a webinar on that topic about cards maybe naturally means that more are interested in. Very, very interesting. So again, there's still a few moments to answer that. We'll take it off to the side, but thank you for answering these polling questions. It's very useful for the audience to see what's going on. So with that, we'll move that off to the side, and we'll go in their summary. I'll take the left-hand side, and then Stephanie, you can do the last three. Then we have some announcements at the end and some recaps. So what are the major considerations for Treasury? What's the adoption of particular card programs, of ACH or checks? As you look at payments more broadly, you have to consider each of those, and those factor into the level of preference. Card payment security, this is an area that was early in being attacked and early in adding additional controls to the process. Card payment security, all payment security is vital, not only your internal training, but how you continue to try to stay in front of most of the criminals and provide, and as these processors and issuers handle and manage some of the risk. We look at bank relationship management. When you look at adopting cards and using that, are you going to use a bank partner, or a third party? How will you go about selecting those? Will you use an RFP? Will you do more of a conversation about items? So more formal or less formal? That can be driven by the size of your organization, too, where you may not have the resources to be formal in your approach. You need to be more informal. Those are the first three considerations for Treasury as you look at card programs.
Thanks, Craig. And the other three on the other side, what does the future hold? Do you want to implement a short-term solution? Absolutely not. You want to make sure that your program that you're going to be implementing for any type of payment is something that's going to be more long-term and not impact the company negatively, meaning you have to shuffle things and do it all again. So making sure it's not going to become outdated or be inefficient. So those are some things that you want to make sure any payment solution has. And then cost effectiveness and liquidity management. We talked about this in depth earlier, making sure your program is cost effective, that you're utilizing it for both liquidity and working capital management, but making sure that you're using it effectively, that it is cost effective in that regard. And then making sure workflows at the end also follow through the same. They're not going to be the same as paper or EFT payments, but making sure you have very efficient workflows that have the controls in place to manage it. And I know they have another poll question, but the three things, if you're going to adopt a card program here at the end, just make sure you have an internal discussion I won't go into detail. Once you decide whether or not a card program is something you want to do, start having those external discussions and also develop an implementation plan and select a provider. So these are the three main things that you need to look at if you're looking into implementing a new card program. I'll hand that off now. Michelle.
Thank you everyone for joining us today, and thank you to our presenters for a very informative session. I do have several announcements, so bear with me for just a second. We will stay online for a few more minutes, so please keep sending your questions. We will send the credit form, a copy of the deck, and the recording within the next few days. We have also introduced a new system to allow you to provide us with feedback on our webinars. Please click the link on your screen to leave us a quick anonymous review, which we would greatly appreciate. If you don't see this review form, please refresh your page. Again, thanks everyone for joining us today. Please let us know if you have any questions and continue checking our website for upcoming webinars.